National home price growth cooled to just 1.2% year-over-year in September, marking the weakest reading since the post-COVID surge. While the overall market appears to be stabilizing, the story beneath the average is one of increasing fragmentation. Inventory is rising, but demand isn't evenly distributed. Regional differences are sharpening. Markets like Connecticut, New Jersey, and Wyoming posted price gains above 5%, while prices in Florida and D.C. declined. Strong local job markets are helping some metros hold value, while others are seeing equity erosion and cooling demand. 20% of U.S. metros saw year-over-year price drops in September, the highest share since mid-2023. That level of geographic dispersion signals a market increasingly driven by local fundamentals, not national trends. For lenders, that means credit conditions and pricing risk will vary widely by region. Affordability remains the market's pressure valve. Real mortgage payments are up 72% since 2020, and escrow costs have climbed 45%. Even with some rate relief, the monthly cost to buy remains historically high, leaving many buyers sidelined. Hybrid work continues to reshape housing demand. Mid-sized metros like Allentown, Albany, and Omaha are gaining traction with high-income commuters looking for better value. These spillover markets are emerging as absorption hotspots, where buyers are still active if the price is right. We're seeing a clear K-shaped demand curve. Buyers with stable incomes in sectors like finance, biotech, and healthcare continue to transact, particularly in Boston, New York, and Philadelphia. For everyone else, affordability gaps and job uncertainty are holding back demand. For mortgage brokers, this market calls for structural creativity. Think rate buydowns, ARMs, and layered affordability strategies. For realtors, it's about location-specific insight. National headlines no longer guide local deals. Success will depend on identifying where buyer momentum still exists and matching that with financing flexibility. Realtors should focus on resilient Northeast markets with strong job sectors like finance and healthcare. In softening metros, pivot to hybrid workers, investor clients, and creative deal structures to maintain transaction volume. With price growth slowing and inventory rising, buyers have more negotiating power than before. Success now depends on deep local knowledge, adaptive positioning, and clear client education rooted in market reality. For more insights on segmented markets, lending strategy, and diversifying your revenue streams, stay connected with the Academy for Commercial Lending.